Hello and welcome to the CFA Society San Francisco podcast, where we interview and discuss current topics with leading members of the Bay Area investment community. This week, Tanya Subatang, Senior Membership Manager with CFA Society San Francisco, sits down with Steve Biggs, CFA, Managing Director and Head of Alternative Investments for the Mathe Group. Listen in as they discuss alternative investing and private markets.
Good morning, Steve. I'm so excited to have you on our show today. How are you?
I'm good. Thank you. Thanks for having me.
Well, let's get to it. So, Steve, you are the Managing Director, Head of Alternative Investments at the Mathe Group. Tell me about the Mathe Group and your role at the firm.
So the Mathe Group manages about $10 billion for individuals, whether they're high net worth or up to family office size clients. So we've got about $8 billion in high net worth individual assets and about $2 billion for family office clients. We are registered with the SEC as an investment advisor, also known as a RIA or registered investment advisor. The firm was founded in 2010, 13 years ago in Chicago, and has since grown to this size, both through organic growth and through M&A acquisitions. So I came to the firm about a year ago through an acquisition. We had a firm in the Lafayette area, AC Financial Advisors. We managed about $500 million for individual clients and joined the Mathe Group. You know, we had always had a heavy allocation to alternative investments. And I've got some of that in my background as well. Started my career on the pension side and had some allocations I worked with KKR a little bit, had some allocations to some private equity funds. So we were always a little bit more aggressive in adding private alternatives to client portfolios and using those as a way to diversify and enhance returns. So with the Mathe Group, there's very much a history in low-cost, tax-efficient public market portfolios, which obviously worked very well and they helped grow the firm and, provide good returns for clients. So, but I think we're at the point where it makes sense to have some alternative offerings. So my role with the firm is to roll out alternative investment platform to all the clients. Now that's going to look a little bit different for someone with $1 or $2 million versus, a family office client, but there's a number of options out there. So we're about a year into the process. We've got some offerings and it's starting to get a little bit more aggressive and ramped up with clients. But it's, I think, a multi-year process, and we're off to a good start.
Well, that sounds good. So obviously, given your background, I'd love to hear, how has the market for private investment for individual high net worth investors evolved over the past decade?
Yeah, that's a great question because, you go back to private equity and real estate has been around for decades, right? And has always been an important part of portfolio allocation for institutions, especially pensions and endowments, as far as, getting a differentiated stream of returns. But when it comes to individuals, it's been a tougher market, right? We've seen he switched over to the high net worth side of the business in 2008. And there were some options for alternative investments, but I don't think any of them were that good that I saw, at least. I mean, there were firms, hedge funds trying to come into the space, and just by nature, they're very high fee, and it was just not an efficient way to do it. And, and private markets is also a lot about access to managers. So you need to make sure you have good managers in there. And, the managers weren't necessarily what you would allocate to as an institution. So I think early days, it was expensive and lower quality, but it's certainly improved. I think there's a recognition, obviously, by private asset managers, alternative managers, that there is a lot of assets here, and that these are really untapped. So, as the world has evolved from defined benefit plans to defined contribution plans, defined benefit plans always had allocations to alternatives, but now it's moved over to the individual, and less access has taken assets away from defined benefit plans. So, so the managers have looked more towards our part of the world. And as wealth managers, that's kind of the sweet spot. If you get, too far down, it's just really challenging. Not that an individual with less assets should not have access to some of these investments. It's just much more of a challenge. So as a result, the quality of the offerings has improved significantly since I started in wealth management 15 years ago. And we've really started to see the quality of managers come up, the fees, although although alternatives are always going to be more expensive than public markets for a variety of reasons, they have come, more into line where the excess fee you're paying over, say, a $1 billion endowment fund is not that great that it would make it, not investable. So I think quality has improved quite a bit. I mean, we've seen stuff in the past. Non-traded REITs originally were, almost ensured you were going to lose money because they took the money in, sent it back out, and had extremely high fees and eventually go public. And then, really with Blackstone in 2017, 18, BREIT came around, whole different, version of the non-traded REIT. And we've seen a number of follow-on options too. So I think it's continuing to improve and much better opportunities for individuals.
Well, that sounds good. So you were talking about alternative investments just a little bit ago. So what are the challenges to allocating to alternative investments for individual investors?
Yeah, well, they're not institutions, so there's definitely some challenges. And I think it starts with education and comfort levels too. So, talking to our advisors and our clients, everyone's used to having daily liquidity or the perception of daily liquidity, whether markets are as liquid as on a bad day as a good day is up for debate. But, there's a perception that there's additional risk with liquidity, and there is liquidity risk, but it's something that you can protect around by providing ample liquidity in other parts of your portfolio. So it's a risk you're getting paid for. It's not really a risk. It's as long as you can manage the liquidity is fine, but it does cause concern of clients. So, it's really kind of getting the education out there. And that's what we've found as one of the biggest challenges to growing acceptance among the client base, and then liquidity does pose a challenge for some clients. So that's one of the challenges, and it's the structure of the fund too. So if we think about the institution that invests, it's a drawdown strategy. So you commit to a fund and capital gets called on a fairly regular basis for 3 years, 5 years until you're fully invested. And then the fund life can go 10 years, up to 15, 16 for a venture fund with a very long time horizon. So, the industry correctly identified that that's probably not an ideal liquidity structure for everyone, has come up with the interval fund, which may be too liquid, right? It's by offering quarterly liquidity, you're also introducing either a cash drag because you need to have some liquidity there, or you're buying public market investments. So you're adding correlations to public markets. So it's not a perfect structure, but there's more and more options coming out that may fit people's needs. So I think even with the interval fund, you're not getting 100% of the illiquidity premium, but you are capturing a good amount of it, and you are getting exposure to some of those assets, whether they're kind of the smaller value part of the market, part of the equity markets that you're not necessarily going to get through public equities. So that's a big part of it. And, I think there's going to be evolution in fund structures, but that's certainly one of the bigger risks. And that's generally what we're dealing with is education and managing liquidity and, managing size.
Well, given everything you've shared with us, how do you see things changing in the coming years?
I think there's still a lot of work to do on fund structure. What we're using, there's still, the drawdown vehicle can still work for the ultra high net worth or, even come downstream a little bit. But I think this interval fund structure has to progress. So, basically what's being used is a 1940 Act fund. Now, 1940 was a long time ago, and no one was thinking about putting private equity in a open-ended mutual fund or a 1940 Act mutual fund. So it's great that they have figured this out and being able to get some kind of exposure to it. But I think the industry needs to evolve a little bit. If you look at public markets, they used the 40 Act fund until late 90s. And, eventually some of these fund companies developed a better wrapper for this. And it was a exchange traded fund or ETF. And you don't see a lot of public market funds as a 40 Act fund being launched anymore. It's all exchange traded funds for a variety of reasons. So I think it's incumbent upon the industry to develop the next structure. How much liquidity do we really need? Can you still stay registered? Can we do annual liquidity? Is there a way to not have to buy something or sell something at an inopportune time and still be able to capture more of the liquidity premium and not keep some of that money in cash or in short-term instruments or public market equities and deliver the full benefits of a private investment? And I've seen some progress, and there's probably ways to do it, but I think there's a lot more progress to be made here. I know, and it may come from one of the traditional mutual fund companies and not the big alternative manager. I know that there's investment in blockchain. I think Franklin Templeton has been very aggressive in acquiring blockchain companies. So maybe that's the answer. You can have an active secondary market for private investments without actually offering liquidity through the manager in the interim, but still providing that to clients, because individuals still need some liquidity. You don't have if you're an endowment, if you're a pension, you know what your liabilities are with pretty good certainty. If you're an individual, you may have an idea of when you want to retire. If you have kids, you may have an idea when you have college, but there's all kinds of other stuff that can come up, right? There's health issues, there's, everything. So, so by definition, an individual does need a little more liquidity. So I think if we can find some kind of balance between that lockup for 10 to 15 years versus, hey, you can get your money out every 3 months, you don't need that much liquidity. So why pay for it? Why pay for something you don't need? So I think that's really the developments we'll see, and I think it's going to be, there's a lot of regulation that has to happen for that to all work out. So I think that's going to be the challenge. Is the technology, is regulation going to keep up with the technology, or is it going to hold it back and make it tougher? So I think there's benefit to having SEC registered funds like the interval fund, but something a little better than what we're currently offering.
Well, Steve, thank you so much for all that wealth of information. It was truly a pleasure to speak with you today. And I believe we're going to be seeing you at a lot of future events. So I hope our listeners get to catch and learn from you some more.
Sounds great. I look forward to seeing you, and thank you for having me, and catch you at a conference in the near future.
Sounds good. Thanks, Steve.
Okay. Thanks, Tanya.
Thank you for listening to this month's episode of the CFA Society San Francisco podcast. We hope you enjoyed the engaging discussion. Join us next month for another new episode.